All opinions expressed by the Kendall Report participants are solely their opinions and do not reflect the opinions of VPM Partners, and may have been previously disseminated by them on television, radio, internet, or another medium. You should not treat any opinion expressed on this broadcast as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of an opinion. Such opinions are based upon information that the Kendall Report participants and Robert Kendall consider reliable, but VPM Partners does not warrant its competence or its accuracy, or should it be relied upon such. The Kendall Report participants, VPM Partners officers, directors, employees, contractors, guests, are not under any obligation to update or correct any information on this broadcast. The Kendall Report participants are professional traders or investment advisor representatives who may be actively involved in securities herein on behalf of themselves, their companies, and their clients. Also, the opinions expressed by the Kendall Report participants may be short-term in nature and subject to change without notice. No part of the Kendall Report participants' compensation from VPM Partners is related to a specific opinion they express. Past performance is not indicative of future results. Kendall Report participants and VPM Partners do not guarantee any specific outcome or profit. You should be aware of the real risk of loss and following any strategy or investment discussed on this broadcast. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned in this broadcast may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as recommendations appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this broadcast. Before acting on the information on this website, you should consider whether it is suitable for your particular circumstances and strongly consider seeking personalized advice. Nothing contained in the Kendall Report broadcast or VPM Partners on its website or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by any particular security, other investment product, transaction, or investment. Copyright 2017 VPM Partners and the Kendall Report, all rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic media in whole or in part is prohibited under penalty of law.
Now, for your host, Bob Kendall.
Welcome, everyone, to the Kendall Report for October 29th, 2018. So we have just, after today, 2 more sessions left in this month, and it's been a pretty horrific month, but it's lived up to its normal reputation of being a really bad month. It also has the reputation of being the low for this period of time. So we could see some recovery as we go on, but there's more going on this time than usual. And with it being midterm elections, those are going to have, the outcome is going to have a huge, huge impact. There's a number of things I'm going to want to discuss today, but we're going to focus on, as usual, on the S&P and go through the composite, some of the other indexes, and some of the elements of the global equity strategy. And as I've been discussing over the past several weeks now, our database has just completely imploded. We're down to 11% long. I have to tell you, in 2008, in the middle of that crisis, the database got to, I think, 7.5% long. And we're virtually there. I mean, we don't own anything, which, like I talked about last week, I haven't seen this type of scenario for a while since then, actually, and I haven't seen the database roll over this quick. Typically, it's a soft roll, and I've told people for years, I mean, this company's been around for 20 years, and even before that, when we were in development, it was pretty obvious when we get these hits in the market, it would take between 2 and 3 weeks for the database to respond to a change in trends. And when we started a company, I think we had like 4,500 symbols in a database. Now we're just really close to about 18,000. I think it's 17,700 and change. And so this big roll that we're seeing, it's everywhere, right? We've seen, selling in the bonds, equities, just across the board in virtually every asset class. And this is where literally allocation theory really goes down and doesn't validate itself, because what we're seeing here is all assets moving in one direction. And even though the bonds backed up, we'll talk about that in the interest rate section today, but even though that happened, they backed up, what, 8-10 basis points. But the point is that everything is done. I did it 2 years ago. I did a report that was 60-40 was dead, right? Well, 60-40 is definitely dead right now. You've got bonds for the most part going down. You've got equities going down. So the whole allocation 60-40 thing is really under a lot of pressure right now. And we've seen a heck of a month. We're down, I think it was a NASDAQ. I don't have the stats right in front of me. I talked about it in the commentary, but it's like minus 12, 8% this month. It's been a big hit. Last week was 3.94 on the S&P. So we're seeing definitely an implosion of everything that all the asset classes. There's virtually nothing that's going on. So before we get into any more of the show, let's just talk a little bit about what's coming out this week. We do have an employment report coming out, but as we look at today, we've already had Dallas Fed. None of these are really material right now, by the way. We're looking at tomorrow. We have consumer confidence. It's really, there's nothing going on here. We do have the Case-Shiller Index, which will tell us a little bit about real estate. And that's probably the biggest area. People are starting to focus a little bit on the real estate slowing down and what does it mean for if markets continue to the interest rates continue to go up, what's the effect on real estate and those elements. But I don't think it's material to the economy right now. And then on Wednesday, of course, we have ADP. Let's take a quick look at that. We'll bring that on screen. And ADP is expected to be 178 is the consensus here. So been pretty consistent, 150 to about 220 almost every month. It's been really consistent. And right now, market sentiment is not being affected by employment or really anything. It's really, I think, and I've said this many times, is that I believe it's all about the midterms. It's about a lot of uncertainty. Everything that you go down and do analysis of is uncertain. And that's why you're seeing this crazy volatility. The VPM 3-day volatility index is at 69.91. And we've already seen about half of that so far today. When we go in and talk about the S&P, we'll cover that a little bit more. But the realities is that we're seeing much more volatility. This is not going to go away anytime soon. Let's finish the week here. On Thursday, we got PMI manufacturing, ISM manufacturing. Those will have some relevance, especially coming into the employment report. And let's take a look on Friday. The employment report on Friday will be actually looking at 190, very similar to ADP. As most people, and I'm sure you folks are aware, the ADP report most time is not correlated to what comes out in the full report that comes out on Friday from the government. So there's not a lot of correlation. Sometimes it leads and sometimes it doesn't. It's a flip of a coin, so there's really nothing there. So unemployment expected to stay unchanged. Private payrolls looking to bump up pretty good. Participation rate to tick up a little bit more, and that's been really positive. More and more people, I forget the number now, but there's something like 90 or 180,000 new jobs out there posted, and it's just not, every month that number's growing, and it's big. So anyway, we'll go back over, and what we're looking at here as far as the markets go, you're really looking at the employment situation is going to be the big event for this week. So everything's going to be focused on that. I suspect we do have quite a few earnings coming out as well, and we're looking at 1,028 earnings. Earnings weren't very friendly last week. There were a lot of big misses. Of course, Amazon and some of the big names that are out there. Those names have been pretty significantly impacted, and the FANGs have been impacted across the way. And we'll go through the technicals on everything here, and we'll go ahead and dig in right now. And don't forget, by the way, about midway through, about half past the hour, if you have any questions, you can start posting them on the live feed. It would really, I think it would make this show a little more interactive and interesting if I were able to answer some questions. So don't hesitate to ask questions if you have anything. As we go here and look at the S&P, we have the daily graph up here. This is pretty interesting. I wouldn't be surprised, we're moving that way right now, that we end up going negative on the session. We traded up right into the resistance. Today, if you look at the commentary, you'll see that resistance 3 was 2712.1. We got up to 0685 and I think backed off right away. I did tweet earlier this morning, if you're a trader, that you'd want to short this opening, and we were going to come back in. And typically what happens is markets will open higher, they'll pull back, and they'll surge and make one more new high, and then you can sell them. And that pattern happens almost on all the big openings. The inverse happens on the lower openings. So there's usually, in this kind of volatility where we're expecting, anywhere from 40 to 60 handles, there's a huge opportunity for some of those short-term moves that we see. But as we look here, we continue to see the PPM1 on the daily graph is at minus 0.28. PPM2 now is minus 0.40, and then PPM3 minus 0.20. And I talked about this in commentary. This is important in that we're looking at we're actually seeing the 200-day moving average turn down. And I talk about this a lot. Those of you that understand my work know that I have been discussing this for this is the basis of what I do. So I'm looking at every moving average. All the indicators that you see on this page are actually telling us what the percent change, first and second derivatives of the percent change, which tells me what the angle of attack and how likely a moving average is continuing to be a support line, or in the case of what we're seeing here, a resistance line. So at a 0.29 basis, you're going to see it's approximately at 0.29, it's 0.60 probability that it's actually 0.40 that the market can go above that 10-period moving average. So same thing as we carry it all the way through the spectrum. I use 10, 21, 40, and then we have the 200-day up here. I started this about 4 months ago, and the 200-day now is negative. It's negative 0.01, not much, but it's a very slow moving. But what it's doing is it's starting to slope down. We have not seen this thing slope down since 2015. I talked about that in commentary, and this is a significant event. Now in 2015, we got down to I think it was 1810, 1812. There were two hits, one in 2015 in August. And then in the beginning of 2016, we set up the 2016 low, and it bounced and went down, I think, 1812, or it might have been 10. One of those two lows. You can see those. They're not on the screen here on this daily graph. But here what we've seen is something else that's significant. We never have gotten through the 200-day moving average, which is also very similar to the 40-week moving average, which was also the 10-month moving average. So we continue to see that the patterns they're setting up here are much, much different, very much different than even the decline that we saw earlier in the year off the high on January 26th and into February. This is a different pattern completely. Not only that, the VPM database has imploded, which is telling us even more about the underlying trends. I was in a little bit of chatting with somebody last night on Skype, and they were starting to get in kind of a debate over what's going on, that the market's going to bottom here. Well, it might very well, but right now the internals of the markets, the number of trends that VPM tracks. And I always tell everybody I'm like one of the luckiest guys in the world. I can watch 18,000 items all doing the things that I developed and think about. Very few people have that kind of expansive environment to watch. And I've been doing this for over 20 years, watching this database. So I have a really, my thumb's right on the heartbeat of this thing, and that's why I always talk about all of these things, the angle of attack, how things are rolling, all of that stuff. I don't look at any other indicators than you see here. I don't look at RSI or MACD or any of the typical, what I call retail kind of view of the world. Everything you see here is proprietary indicators I developed, and it was about understanding that angle of attack, which is work I started way back in 1984. And so, I've been doing this. This is my life's work, and this is the way I view the world. And so that's, I don't go in and talking about, you never hear the words overbought, oversold. I don't believe in those things. They do get that way. Markets do get extended, but I don't look at those kind of indicators. I don't use any of the 0 to 100 meters like a RSI or, stochastics or any of those, because they just kind of get pinned up the ceiling or at the bottom. It's very hard to make an analysis. So I look at pure output of momentum through the moving averages, not through the closing price of the stock. So little tidbit there, but what this is telling us is that all of the trends are down. We've got the database actually imploding. I'll show you in a few minutes, and everything that is important to me in understanding the markets is positioned, and I've said this over and over in the last several weeks, is that our database is positioned for a catastrophic event. Now, I put out Twitter like a Black Monday. Well, we're not having a Black Monday, at least not at the moment. I really thought the setup was pretty significant. We did do something on Friday. We traded down. I talked about a target of 26.32. The low on Friday was 26.28. We ran from 26.28 all the way to 26.92 from that low, and then came all the way back into the 40s again and finished at 26.58.69. So we had quite the range there. We got the 3-day VPM volatility indicator was at 74. We fulfilled that thing completely. Today it's at 69.91. I expect that we'll see some contraction, just the way the week is set up, the news is set up. We do have a lot of earnings that can move things around, but just looking at economic news, I suspect everybody's going to be thinking and looking forward to Friday's action, and we'll see how this thing all plays out. We're trading down to pretty critical levels here intraday at 75. If you look at the 75.20 was the resistance one, and when we gap up like this, then those resistance numbers that I post on commentary are actually then support. So 75.20, right where we are, right in this range right now, is going to be support. Next support is going to be unchanged on the day, and I suspect we could see 26.42 yet today. If we did that, that would give us right at that 60 handle range. Whether we go into that range or not, we'll see. Let's take a look at the intermediate trends, and this is quite revealing as well. Let me go full screen. So what we're seeing here is similar. If you look at the PPMs, we got PPM 1. I'll bring this on screen. Down at the very bottom of this, PPM 1 is 0.69 minus 0.17 and minus 0.17 on PPM 3. So all this is rolling down. I talked about the 200-day moving average. Well, the 40-week moving average right now is 27.59. The 200-day moving average is roughly 27.54, very similar numbers. And when we look at the monthly graph here in a minute, you'll see that the pattern or the 10-month moving average is a very similar value. It's right around the 27.50 range. We'll look at it here in just a minute. But what you see here is all of the PPMs, what you're telling us the angle of attack is negative, 0.70 on ppm1. I'll move this scale up a little bit. See the ppm1 at a minus 0.70 tells you there's a 20% probability. So 8 times out of the 10, it will not penetrate the 10-week moving average, currently 28.27, but it's dropping. Let's see what it's dropping at. It's dropping right now at about 20 handles per week. So in 2 weeks from now, we'll see a lot lower levels than what we're seeing right now. That'll come down into probably, once again, in 2 weeks, 3 weeks, it'll be 27.50 again. And this is a big, so we're going to go over to the monthly graph here. This is a huge, I can't emphasize how important this is right here. I'm going to do something else here. I'm going to go for a little more data. I think it's only got, it's got 20 years. Let's put 40 years of data up here. And you'll see a couple things. We have come pretty close to the 21-month moving average, but here's what I was just talking about. Look at this. The 10-month moving average, 27.55. 27.57 is the 40-week, and the 200-day is at the 27.55. So they're all exactly the same number. So this is a big event. We're trading below these levels, and we're 2 days from a monthly close. And you can go back. You won't see a monthly close, and you'll have to go back to 2015 and 2016 when we got a monthly close below this level. But let me show you a couple things that are important to understand here. And I'm going to try to draw some stuff on here on this screen. But what you're going to see is that 2612 is the medium address average, which is the 21-month moving average. 2612, we hit, as I just mentioned, 2628. So we've been down to that number. Now that number is big. It's 0.72 up, which is that's significant. The probabilities of going through that 2600 right now is very low. So I suspect we will see a retest, potentially a Friday's low, and then I think we'll see some recovery. And I don't know if we're going to be able to, this is going to be the big number, this 27.55. Like I said, 200-day moving average, 40-week moving average, 10-month moving average, and all of these are turning down. If you notice here, the ppm1, I'll scroll up a little bit here, ppm1 is flat, 0.01 negative, right? So it's basically flat, and ppm2 is still up a lot. I just talked about that. But we're actually seeing this starting to flatten out and roll over. And this has been extremely robust over the past year and a half. Since the 2016 low, this has been accelerating. This is the first time we've seen an deceleration. Not only that, first time we've seen it start to go below its first and second derivative, which tells us all about that angle of attack. And the angle of attack is now turning down even on a long-term secular graphs. And this is important. There's something else, and I meant to bring this up, so bear with me just a second. I meant to have this graphic up. I made a graphic so I wouldn't have to do it live. So just let me grab this really quick here. I should be able to get it up very quick here. Here we go. So I'll go full screen. I'll show you a couple things, and this was very, very significant from the standpoint of, I'm going to see if I can make this just a touch bigger. There we go. So what you'll see here is a couple things, and this stuff what we were just talking about is how the market is starting to roll over on the monthly. But this is important. I drew these red lines in here, which are the previous peak way back in 2013, and we have been operating. Every new high has been a divergence, but this is the second time. This was the right here where you see my cursor moving at the top up here. That was the 2016 lows. But what we had then was an upsloping 40-month moving average. And that's where it found support. And at that time, interesting enough, the 40-month moving average, 200-day moving average, and all these things lined up at that point. But what I'm talking about here is this massive divergence and it rolling over. This is the most likely a huge turning point in the charts, and we're going to start to see the S&P move down into 2,300 handle, and ultimately, I talked about this before, this number over here, 1523, which would be a retest of the highs of 2007, 8. It was actually 2007 when we hit that, and that was also the high in 2000. So we saw 2000 and 08. 08 made a slightly new high and then came off, and if we came all the way back to 1523, that's a huge number. We're talking about 55% decline. And I've also talked about something over the last, couple years maybe. What I've talked about is that I believe we're coming into potentially a generational high. This thing this phenomena that we've been watching for, the past, I've been watching it for almost 40 years. I came in after the Jimmy Carter days in '79. I started in the markets, came in the Reagan days. We had the huge rally, of course, 87 crash, 89 mini crash, and then, there was 98 was another big deal, and of course 2000 and '08. I've lived through all of these things. And I've had this process with me ever since. So I've lived through not just the markets, but I've been using the same concepts and following the market. So I have a great context from my view in my world on what's happening here. And this I believe is very significant. So we're going to see we have seen the beginnings of something much bigger than what previous tops. And, we've all been concerned about this, the massive amount of debt, $22 trillion almost in debt, and all the different elements, not to mention, we can go through all the bubble scenarios, right? And they're all real and they all exist. It's just a matter, old saying from the floor trading days, we used to say it works until it doesn't. Well, it's not working right now. The FANGs were leaders, all those things were leaders in what was going on in the markets. So let's get over to the, I just want to make sure you understand that the things that's going on in the markets are significant. This is not, I saw Kevin O'Leary, the Shark Tank guy, going, this is a garden variety, correction, and here's what to do. And one of the things you never hear anybody talk about is when you hear them talk about what to do during one of these, they tell you to buy some other asset, some other piece of junk that's not going to work. When we get into markets, like I started in talking about this early in the show, is that everything becomes correlated. And there is no diversification. It's crap. It doesn't work. And what no one ever says is to get the cash. And cash is the one asset that doesn't go down in value, and it does really protect. And that's really what we've done. Most of our equity strategies are probably about 60% in cash, not 100%. Our, things like our global equity and other ETFs, we're most likely you're 100% in cash if you're following by the rules, and it feels good at the moment. We've seen these kind of events in the past where they go down so far and then they snap back and we're going back up to new highs. But you have to ask yourself, after 9.5 plus years of this stuff, is there another rally? Is it all going to go? And if, I talk about this, and it's not a political statement, but if the Democrats are able to get back the House, make President Trump a lame duck, and he can't get anything done other than with his pen, there's going to be a lot of uncertainty come in on the markets, and that's going to set the tone for a correction. And I think a huge correction would be awesome because we have not reset prices for a very long time. So let's go over here. We'll go over to Portfolio Expert and go full screen. Let's talk about the database a little bit. So when we're looking at the database, you'll see right now, bear with me, right now the mutual funds are 13% long, ETFs are 21% long, and the equities are 32%. And typically, most of this, the database viewpoint that I'm putting up here, flows through your portfolios if you have a VPM portfolio. So if you have an equity strategy, you're going to have about 32% of the symbols in your, let's just round it off and say 30% of the symbols will actually be long, still long in your portfolio. So if you had 20 symbols, you're going to have 6 or 8 stocks long yet, and that's going to represent probably about 40 to 50% invested, depending on what your allocation factor is and those type of things. But that's pretty typical. Mutual funds, basically, if you had 10 mutual funds, you're going to have 1. On ETFs, you're going to have 2, depending, and they're going to have to probably be, I'm not even sure what they are right now that is still holding in there. Maybe some managed ETFs that have not done as poorly as the indexes have. So this is pretty typical. And I've talked about this a fair amount. Here's our 33 in equity. If I come up here, you'll see if I bounce this over and let's go to mutual funds. Give it just a second to calculate. Taking longer than I'd hoped. Anyway, the mutual funds are just going to show that this percent invested is just going to be, virtually non-existent. And that's pretty much where we're at here. Let's go over and take a look at VPM 2.0. I got clicked out. And when we look at the database from this viewpoint, the only thing long now is utilities, and that's probably because we've seen a slight rally in the bonds, and that's triggered some of those out. But everything else is out right now. If we look at the database, and I'll just make this a little bigger so you can see it. Here's 11.32% long. There's 2,011 symbols out of 17,763 long right now. Utilities, and actually even the utilities been in 5 days and it's underwater by 3.9%. So it's not exactly doing wonderful. And I've seen this before where there'll be just a few things in the database long and even they're not working. Probably the I wouldn't call it favorite time, but the time that I remember the most was after the 2000 high, and we came into 2001 and 2003. The database, we saw the same thing where we got into, under 20%, 18, 15. We didn't get, I don't think, as low as we are right now. But anytime, most of the stocks that were even long they were even flat, up a little bit, or negative. So there was no money to be made in virtually anything, and a lot of those symbols that were long were somewhat obscure from the typical screening process and stocks that you might end up owning. Because we have in our database, we have virtually everything. There are some penny stocks, even the cryptocurrencies are in there. So there's a lot in there that could end up reflecting in this database. But on this database here, it's 300. We go down to about $300 million capitalization. So there's some micro caps in here. And I'd have to dig through the database and show you what's long out of the 2011. But when we look at what happened on the run this weekend, you'll see it's kind of interesting because what we'll see here is that let me go to this view. You'll see that we had roughly 920 exits on 1.2. We had 336 on 3.2. So we still had about another 1,200. And there were some buys, there were about 200 buys. So that's where we came up with the net was, I have it right here. The net was somewhere I had it. It was just there about 1,000 new cells. So that's what clicked the database down. And you'll see that a lot of this stuff, we're just, these patterns everywhere we go are pretty significant. And if we go back and we dig into some of the database a little further, and we start to look at, like I said, we're virtually out of everything, every sector, everything that we have up there. Everything is neutral right now, and this is significant. And I think I've driven that home pretty good. So let's go ahead. Let's go back over to TradeStation, and let's take a look at, real quick, let's just jump over the composite on a monthly basis. I think this is worth looking at. You'll see it's not quite got to its 21-week moving average, but it's close. But one of the things that is significant is that we're at ppm 2 is a plus 1.07, and that is going to tell you that the support at that level is going to be substantial. So this is not the point where the markets collapse. If they do, then there's something way big happening, and the so-called conspiracy of the crash prevention crowd out of the Fed and the Treasury aren't playing their game. But we're looking at right now the 68.87 is the floor. That's 300 points on the composite. We're not going to go below that. There's actually less than a 20% probability of that. And we are under the 10-month moving average, which is 74.74, with the last trade right now of 71.51. So it looks like, unless something unbelievable happens in the next two sessions, we're going to close under the 10-month moving average. Like I said before, you got to go back to 2015 to get to there. But the difference was, I'm going to bring up just the whiteboard just for a second to show you. And this exists on all of the indexes, by the way. So during this, when we hit that right here, we hit the 40-month moving average. And there was still a really positive. Matter of fact, if you look at this, all of the PPMs were actually expanding. So the 2016 low, in hindsight, was a pretty easy call at the 1800. But now what we've got is, if you notice here, and this may be a little hard to see, but I'll just put some arrows on it, all three of the PPMs are rolling over, slicing through their first and second derivatives, which tells us that the trend itself is starting to roll. And you can go back. Here was the 2000 high over here far on the screen, and you'll start to see these same kind of, this was a little more extreme, and all of the PPMs were going in these downtrends here, and setting up the high all the way down into 2003. And I talked about this a fair amount, and I believe that we're at least into a 2000 to 2003 correction. There's at least 2 years to 3, and there might be as many as 5 to 6. And that doesn't mean we're straight down for 6 years. It means that we're going to hit a low, we're going to bounce up, then we'll make another new low. But it's going to be a very elongated type pattern that we're going to unfold in. It appears after everything we've been through, there's very little probability that this thing's just going to bounce back and everything's going to get okay again. And the reality, I keep telling everybody, the economy is not the market, right? So you can talk about how good the economy is and all that stuff. I mean, like I guess weak research firms like LPL and firms like that are marketing divisions. They're always bullish, and they always come up with stories on why this is going to work, and the market's always going to go up, right? Very seldom. And I worked with a lot of major firms in my earlier in my career. And I mean, let's face it, they're marketing departments. They can't tell the children that things are really bad. I mean, even if you go back to 2008, they even were completely on another planet, or they weren't telling anybody how bad things were. They weren't, talking about it. It's funny. I was like looking through some old stuff in '08, and I found a thread on a chart that an old friend of mine was being quoted, and there was a whole thread, and people were talking about, I did call the banking crisis literally a year before it happened. And I did that because of everything that I'm showing you right now. The banks were rolling over. I mean, people thought I was crazy when I told them Lehman was done. They thought I was crazy and Bear Stearns. I said this in July of '07, not 3 months before Lehman. I mean, Bank of America, WAMU, Countrywide, you name it. These guys that was the easiest thing ever just for me, because I had spent my life in previous life in institutional environment, hedging mortgage pipelines. I knew exactly what was going on. Everybody had the same positions on. And right now, I'm telling you, everybody has the same positions on. You've seen people go from 08, 9, 10, talking about active management, the stuff that VPM does, to actually completely going back and saying, your investments that you do for your clients are nothing more than a commodity, which is just, balderdash. And all I can say, it's just the most ridiculous statement ever. And it's not a commodity. It feels that way, but the markets are set and ripe for a big slaughter again. Just because the markets, a lot of people in the markets, especially in the advisory community, have went back passive, and it's sad actually that they forgot the lessons of the past. But that's the old story that history repeats itself. That's why. So so that was the main thing I wanted to show you on that. Let me get rid of this. And so let's go over and talk about interest rates for a few minutes. Anybody has any questions, this would be a good time to ask. Let's click in here. Let's take a look. I'm still in monthly, so I'm going to invert this over to a daily graph. And it was actually pretty amazing how much the yields actually came back in. I was surprised. They get down to 3.08 roughly, actually into 3.7s, and we're rebound a little bit. And a lot of talk that the Fed's going to back off, they're not going to raise rates. That's not going to happen, folks. They've got to do what they're doing. They're so far behind the power curve. They know it. Trump has said, hey, I heard him say something like Obama had zero rates. It's not fair. But you know what? They have to do it. They have no bullets. If anything does roll over, they have very little to do. And if they back off, you heard this here, right? If they back off of raising rates, that will be a message to the markets that things are getting bad, and it will accelerate exactly what people think is going to have it stop. It will be a message to the market that things are worse than you thought, and they're just confirming that. They have to keep pushing forward. They have to raise the rates. You're going to see the 10-year right now is at 3.10. You're going to see 3.6, 3.8. Probably somewhere just below 4.2% on the 10-year. And you'll see lots of movements in the yield curve is going to rebalance. Some of you know my background. I spent 7 years as a consultant to some of the largest banks on the planet, doing yield curve analysis and those type of things. And all this stuff is going to come back in line. Part of the normalization is changing and getting the yield curve relationships back in line. A lot of people are worried about things inverting and those type of things. So let's dig in just a little bit more here. Take a look at the yield curve, and you'll see they have been steepening a little bit. You'll see here on this screen here that a lot of these, we've downticked last week, but we're in this consolidation phase with all these yields. The one thing that didn't downtick very much is that the yellow line at the very bottom is the 13-week T-bill. and that is continuing to climb. We're at 2.26. That is going to be 2.5 at least by December. We're not far from there now. We're talking about 6-8 weeks. That's going to continue to move up. Fed will bump the Fed funds rate again, and it's basically is going to reflect in the 13-week, and the spreads between all of these yields will stay somewhat the same or even steepen. So that means instead of on the 10-year that we were just talking about, that's going to push the 10-year up to 330, 340 range. And depending on what's going on in the backdrop, who knows? Maybe this will be post-election when all this happens. There may be even further movements that happen that will exaggerate that move and maybe push us up to that 3.6 level. I actually think that Q1 of next year is going to be the place where that actually happens. I don't see that happening very quickly or very soon right now, but I do see 20 basis points across the board as the 13-week, the Fed funds rate ticks up again. The debate is right now is what is normalization, and that's somewhere between 2.5 and 3.25, depending on who you're talking to. And if we go to the short-term rates at 3.25, then you're going to see these longer yields ultimately like 10. The 1030s are going to be way up 4, 6 to 5%. And then the question comes, what does that do to the economy? There is a huge number, trillions of dollars of corporate debt that has to be rolled over in the next couple of years. That's going to affect earnings. It's going to affect everything. And if there is a slowdown on top of that, then it's the perfect storm for a pretty big market decline. And during this time, and I said this earlier, is that the 60-40 scenario, if you think that strategy is going to work out for you in let's say in the intermediate term, 6 to 8 quarters, probably not so much. That's going to be a pretty tough strategy. And, so you definitely want to have a managed bond scenario. You want to have a managed equity strategy, and you want to be able to add some cash, because what cash does is it changes the beta relative to everything you're doing. So even if you have 30% equity and let's say 30% bonds and 40% in cash, it's going to change a huge element on how your performance is going to be in those accounts and what it's going to do, and ultimately how your customers and clients are going to feel, because that's the important part, and they're going to actually see that you've adjusted their risk. And we've been through this a lot over the years, and we continue to see customers really happy. I remember back in 2008, I had an advisor call me, and he asked me if I had a minute, and I said sure. And he was telling me about a client that just called him, and the lady was crying because she just left her clubhouse, and these were people not in assisted living, but in their 80s, and she said, all my friends lost so much money they don't know how they're going to pay their bills. Thank you for not losing my money. And that was such an amazing, that made me feel really good that that was my whole point of starting this company 20 years ago. It wasn't about helping advisors. It was about the real user of our software is the clients, the individual clients, and protecting their capital. And that was the whole mission all along. Capital preservation, number one, and then appreciation when appropriate. And right now, we're full protect mode, and all this interest rate stuff and all this stuff is going to come to a head. And there's going to be a huge readjustment in the markets. It has to happen. It's most likely the time is now. I don't know what could come out and make things better. We had the tax cuts. Go one more step with it. What if Democrats get in? What if they did reverse all the tax cuts? Think about what that would do to the market. You can take about 15% out of this market right now, because that big bump that we got after tax cuts, that's been removed for the most part. So part of it's out. But forward-looking earnings are going to get crushed between interest rates going up. If the tax cuts were to come off, that's going to be a huge effect. So you've got nothing but headwinds, and And you, like I said before, all of the moving averages on the big indexes and everything, our database, everything is telling you this is not a good time. This is a good time to be, raising capital, telling customers your stories and all that kind of stuff. Not necessarily a good time to be fully invested in being an allocator. This is going to be really tough. You think you can average down? Maybe so. We'll see. So let's go one last place. What do we got here? We got about 10 minutes to go. So let's go over and let's take a look at, I didn't cover the dollar last time, so let's go. And this is a big issue too, especially for the emerging markets. This is a big deal actually. And what we're seeing here on the dollar, it continues to move up. It's 96. I talked about it going to 98, maybe as high as 102. And this is the daily chart. Let's go over to the intermediate just so we can get a better feel for this. The intermediate, you see this pattern, and I talked about this during these months, and now we're seeing PPMs all turning up and turning sharply higher. This is telling us that we're going to head for this 100. The highs that we had in 2017, let's just take a look at that. Highs that we had in 2017 was right at 101.875. So I suspect we could get up to that level. And I was talking about back in 2017 that if we followed through, we'd see some of these levels up here hit. You see the targets were over here in this column here. You can see 105 to 107. Well, we currently don't have any pattern projections right now, but we'll see what comes out of this thing. It's very possible we could see some numbers. And if they come out of this pattern here, you're going to see at least 105 to 110 is going to be the target. And that spells bad news for emerging markets and other elements and out there. And the one thing that has, let me go over here and do one last thing. And let's take a look at the secular on the dollar, long-term monthly. And you'll see this brings this pattern in pretty good. I'm going to expand this data out just a little bit. And there's not enough on this index, it doesn't look like. I'll put it out here, but I don't think there's more data on this. Yeah, so that's all I can get here. But this pattern here goes to what I was talking about is this point here was, like I said, the 101 level. So I think this pattern here will extend us into new highs. There was a projection way back here for 111 to 123 on the dollar. And that's, even though it's not calculating right now, this pattern, let me just bring something up here. We've got about 8 minutes. This pattern is valid, and this would be the projection where we get basically this pattern here, and then you get something like this, and you get it moving up, and so this whole trend starts to emerge and start to go up into that range. I often talk about the reverse fundamental analysis, and I haven't really thought through if that were the case, what would cause that to happen, except for everything I just talked about, which is higher interest rates. That's definitely going to propel the dollar higher. This will absolutely crush the euro. It'll crush the emerging markets. It's just going to be a really negative market scenario here. And reason why, if this happens, then that tells you a lot about what's going to be going on this planet. And The dollar is still the big reserve currency. There's a lot of talk that what do they call it, the petro yuan, and it's out there and certainly is being used, but we're really not likely to be eliminated from the planet just yet. Like a lot of folks seem to think that the dollar will no longer be the reserve currency, and that's going to continue, and this is going to have ripple effects across so many areas. It's really amazing when you look at it, because all of this stuff we're talking about, the interest rates and any of this stuff, if we get a political climate change, that could be, that's huge. One of the things that I've talked about for years, and mainly because I came in right before Ronald Reagan was elected, and he did the big massive tax cuts in that, in '81. That was huge. That set the tone. In my opinion, that started the, if you look at the long-term trends, that if you go way out, you'll see that this bull market really started during that period of time. We've had some corrections, but this has all been one big sequence. I don't know if I can, let's see if we have a minute. Maybe I can bring that up. We'll go to the Dow Jones, and I can bring up here. I think I can do like 80 years of data. So let's do that really quick. Let's just put 80, and then you get a true perspective of what's going on here. And let me crush this down a little bit, and let me get rid of just a couple things here. Bear with me 1 second, because this will be worth looking at. And I'm gonna take off a bunch of stuff here. There's something still on right here. Bear with me, I'm almost there. There's a lot on this page. I just need to turn off this ppm3, and then we're good to go. All right, there's. Let me go full screen. All the perpetual bulls. Here's the 1980 lows. If you can argue that this is one complete sequence here. And if you've done any Elliott wave work, you would call this a grand supercycle. But this right here, I put an arrow, that's the 1987 crash. That was 40% in 3 days. I was there and actually did really, really well there. But the point is that we have this pattern right here, and I talked about this back in 2003, that what we were setting up, and when we went up to the '07 highs, is that this pattern right here was really one of these bugle formations, and that we would get one more rally up. Well, guess what? We've had that rally up, and when you look at something like this, let me get rid of this now. If you look at something like this, you tell me that angle is sustainable. You tell me that we're not going to, come back to some pretty significant levels. And, this thing is ripe. There's still, you can see these moving averages are vertical. This, I'm going to mark this up a little bit. You can see this is what I was talking about. This is the 40-month moving average. The 10-month had turned down. They kind of crisscrossed right here at the 10 and 21. But you see, there's an argument here. I know I got a lot of lines. 1, 2, 3. This is wave 3, wave 4. This is wave 5, and this is the cap, and this puts us. This is the Dow Jones, so puts us all the way back into 17,000. I suspect I'm going to have fun drawing here. But I suspect this thing ends up looking something like this. and all of a sudden we're out 6 years, and this is what the market looks like. There's very little that would argue that we're not going to go through that scenario. And if you look at the period of time between 2000 all the way to the lows of '09, this is all one big corrective sequence right here. All these highs and lows were all one big corrective sequence. And then we got this big blast up. Well, this is, as they say, wave 5 of 5 of 5, grand super cycle. This is it. And the typical scenario, I'm going to clear this out here. The typical scenario is that you head back. I didn't do a good job drawing that. Let me take a little more care in that. And we'll finish the show here. But this is what they call wave 4 previous degree on a large scale. And wave 4 previous degree here is back to here. So the first pattern we set up is probably in here, and then the next pattern heads down to these levels. So we get this current sell-off. We probably get a little bounce. Maybe I've exaggerated what the actual magnitude is, and then we'll go back, retest the lows, whatever this sequence is, whether it ends up to be what it was last Friday at 26.28, or if we go down to next levels, which are 25.60 to 25.18, whatever it is, this pattern is going to look something like this. Whether it gets down to these levels or not, I can't tell you. It could just come up to these tops, but this is going to be a major deal. And I've said this a lot, and I hate having such a profound statement at the end of the show. But the realities is if you think you're going to get through this next sequence by doing ETFs and mutual funds indexing, you would be very wrong. You're going to need to be much more dynamic, much quicker on your feet. There's going to be very little money to be made, in my opinion, in the next couple of years in ETFs. You're going to definitely have to be looking at individual stocks and all that. And I'm working on with this new channel I have of actually having the going through building strategies and how to understand how to use VPM and Portfolio Expert at this level. So this will finish the show. I went through an awful lot. I think this was a significant show to watch. I appreciate everybody hanging in. Didn't see any questions out there, but really wish you guys just step up. It'd be fun to have some questions, because I know you've got some good ones. Anyway, thanks for watching. I will be on and off throughout the week, so make sure you subscribe. Anyway, thanks again for watching.